Hi, this is John Bird, and I wanted to make a little video about constructing a pro forma balance sheet. This tends to be the trickier part of this financial forecasting stuff that we're doing early in the term. The way we always begin with these pro formas is we create an income statement. That's relatively straightforward. Here's the 2005 figures. These are actual. That's what we're going to base the 2006 numbers on. So we're forecasting 2006 financial statements. I say there's going to be a sales increase of 20%. Cost of goods sold, we'll say it's 62.5% of sales. Here's something about general, administrative, and sales expense, and so on. The things that we have to remember here are that depreciation is 60, and then eventually what we're going to take to retained earnings, and those will be things that will help us construct the balance sheet. So we complete the income statement, and most of it's just following the instructions over here in the notes, or the assumptions, and then adding and subtracting. So we can do that pretty readily. Again, remember depreciation 60, and the amount that we're going to increase retained earnings by 57. We start the balance sheet always on the asset side. We can get those numbers a lot easier than on the liability side. The liability side will be where we're going to balance things. That's going to be where the unknown item or the plug figure is. So again, we have some notes here, and these notes say that the cash will be $70 minimum. So we put in the minimum amount, and I'll show you how to adjust that at the very end of the slideshow. Accounts receivable are going to be 45 days of sales. I use a 360-day year, and so that will be, what's that, 1/8 of a year's sales will go into accounts receivable, and inventory is 21% of sales. So we can do it percent of sales. We can use the days ratio for current assets or current liabilities. Having done that, we can actually compute those numbers. So we plug in our 70, our 45 days of sales, our 21% of inventory. We also know that we're going to buy $120 worth of new assets, so we can change that number for fixed assets. Now remember that depreciation went up 60, so we increased the 875 to 935. That's the increase in depreciation. That's an accumulation account in accounting. We sum the current assets to get 472. Here's net fixed assets less accumulated depreciation. Total assets then will be the sum of the current and the net fixed assets, or $2,232. Now we move to the liability side of the balance sheet, and here's where things get a teeny bit tricky, especially if you're just a little rusty in accounting. We start by bringing in the total number from the asset side. So total liabilities and equity equals total assets, 2,232. Retained earnings has gone up by 57. Remember, that was a number from the income statement. And this is one of the two places where the income statement joins the balance sheet. Common stock doesn't change. That's a par value paid in surplus, so that's historical. Long-term debt, we won't change this particular in this particular example. Now, from this data, long-term debt, common stock, retained earnings, and total liabilities and equity, we can compute total current liabilities. We can add up the debt, the stock, the retained earnings, subtract it from the total, and that'll give us total current liabilities. So we do that, and that number is 225. Accounts payable, I guess I should have mentioned, that's 1/12 of the cost of goods sold. The way I did it was I used 30 days of accounts payable based on a 360-day year, 1/12 of the cost of goods sold for 2006, 62.5. So to get the bank loan then, we're just going to subtract the 62.5 from the 225, and that gives us the plug figure. This is the number that balances the balance sheet, 162.5. Notice that the bank loan went up from 103 in 2005 to 162.5. And we're forecasting things, and what this tells us is that we need to go to the bank and arrange for a slightly larger loan. We have to either warn the bankers that we're going to be requesting more money from our credit line. We have to change the nature of the constraints on that credit line. If the 103 is already close to the limit for the particular bank, we may have to find another bank, a larger bank, that would support our financing needs. So that's how we do the balance sheet up here. Bank loan increased by 59.5 from 103 to 162.5, increase of 59.5. Here were our cash needs. We increased accounts receivable, that's credit that we're offering our customers. That took up $25 more. We increased inventory by 42. We bought some new assets. We also had depreciation, so the offset of the depreciation left net fixed assets going up by 60. That means our total new uses of funds was 127. So we needed $127 more in the company. Now we got part of that from retained profits, 57. We increased our spontaneous financing through payables by 10.5. So our total new sources of funds were 67.5. We needed 127. We got 67.5. That leaves 59.5 that had to be financed externally, and that was the amount of the bank loan increase. So $59.5 balances the uses with the sources. Now, one thing that can happen is, what if the bank loan had been negative? Well, you can't have a negative bank loan. So what we're going to do is we'll change it to 0. We'll compute the total and current current liabilities and total liabilities and equity over again. So recompute it, because now the total current has changed. We'll move the total liabilities and equity number over to total assets. Then we'll adjust the asset side of the balance sheet. And the way we'll do this is just move up and add the amount of the negative bank loan, but with a positive sign, it turns out, to the assets like current assets. And then finally, we'll just put it into cash. So the plug figure now becomes the cash number. And cash will increase by the amount of that negative bank loan in absolute value terms. So let's suppose this happens. We have a new income statement where we make a lot more money. And this could happen, I suppose, if we're doing business exactly like we were going to do it, but the value of our product increases a lot. So imagine oil going up, or Apple Computer selling iPods and making a lot more money than normal. Asset side of the balance sheet is going to change a little bit here from what it was. Inventory doesn't change because cost of goods sold didn't change in the income statement. Let me show you that again. So we're selling the same number of units, but the cost hasn't, and the cost of those units hasn't changed, but the revenue has. We don't need more managers because we're not really increasing the scale of our operations. The only thing that's changed is revenues. We are going to buy some assets. We have some depreciation and so on. All of that is as it was in 2005. So inventory doesn't change because cost of goods sold didn't change. Total current assets have gone up a little bit. Fixed assets haven't changed. Total assets haven't gone up very much. Take that total assets number over to the liability side. We have much higher retained earnings. Now we're increasing those not by $57, but by $240. Long-term debt and common stock don't change. Current liabilities then goes way down. We have so much more profit here in retained earnings that we don't need much in current liabilities. Accounts payable, that spontaneous financing, is the same, unchanged, because cost of goods sold hasn't changed. Negative bank loan now, 43.75. Well, that can't be. We change it to 0, readjust this, and now total liabilities and equity which will become total assets, is now 2,252.5, up from 2,208.75. So we've increased it by the amount of that negative bank loan. That's the difference of 43.75. We go to the asset side using this new total. Fixed assets haven't changed. Current assets will go up though to reflect the change in total assets. Inventory hasn't changed. Accounts receivable hasn't changed. The only thing that can change here is cash. So cash has increased from 70, 113.75. It's larger by that 43.75 number, the amount of the negative bank loan. Now we could have, if we would have wanted to, use the 43.75 to reduce a liability like long-term debt. That would have left the total liabilities and equity at 2,208.75, and we would have left the asset side unchanged with the minimum cash of 70. But we didn't choose to do that. We chose to increase the cash and use that as